this session really is about you and sort of having a conversation. So, sure. Um, we heard from a lot of investors. 2.5 billion of church pension fund money in impact investing. All of Heron's money in impact investing. $1 billion from New Island Capital, $1 billion from Deutsche Bank. So, having all of them, if you saw, indicated market results, or as Heron had indicated, better than market results. So what's the problem? What are the challenges, and why aren't institutional investors coming to the market? And that's really the starting question. And I'd love for some of the institutional investors like the Carlyle Group that's sitting there, or others that haven't spoken, to talk about why aren't they investing, what are the challenges, and how can we sort of overcome that. And that's what I want to, the topic of this session, half an hour. I'm told by Sandra that I don't get any more time. 12:30 is over, and between your lunch, so it's important. So can some of you start talking about what are the key challenges? And it'd be great to hear from people that are in New York City. Retirement pension fund is here as well. And I'd love to hear from some of you as to what your challenges are. So please. There are no challenges. Please, thank you.
Just now.
So I think one of the challenges is one of scalability.
Ian, can you introduce yourself?
Oh, sorry. Ian DaCosta from Touchstone Group, work with a lot of institutional investors on private equity and venture capital, and have done some impact funds as well for them. So I think one of the big issues is really one of scalability. A lot of institutional investors see impact funds and impact opportunities as being really small compared to their overall portfolio, and not enough to make a difference financially. So from that perspective, they say, well, it's only, even if I do pretty well on impact investing, it's not going to move the needle for my portfolio overall. So why do I want to, dedicate resources, research, and all that? Because this is a complex field, and I don't have the time, I don't have the resources to put into this. So it's a little bit chicken and egg. The sector is not going to develop until the institutions start putting, significant amounts of capital into it. But at the same time, they're saying there's not enough there for it to make a difference to me, and there are so many other issues involved that, it's not kind of worth my time yet. So, just throwing that out, that's one of the issues we've seen.
Right. So that's a good point in terms of the time spent on this scale of what it is. So how do we, as people who are interested in pushing the agenda, how do we lessen that? There is some discussion at the end. I think we'll talk about collaboration on due diligence and how that can be achieved, even from a legal perspective. I think Mary talk about can share due diligence just forward. But to carry on Ian's point, is there anybody else who has some thoughts around how do we sort of catch-22 situation, scalability, could see what to do, further this sector? Any other thoughts? Cheryl?
Again, I'd just like to emphasize the need to push regulators to review regulations. Basel 1, 2, 3, I don't think we're at 4 yet. Penalize renewable versus fossil fuel, simply because of the way risk and risk weighting matrix are developed. Until we change that legally, many financial institutions will not be able to move in at the scale that is required. The same thing goes with the pension funds. My largest private investor is a pension firm from Australia, and they're the one who basically opened made to this problem. They say we were only authorized to invest because of the blended finance, and we could demonstrate to our supervisor that the risk, of our for our capital was minimized to an extreme level. Otherwise, although we like it and we think it's a sound investment, despite our own risk review, we would have been blocked of doing it. And I think it's an underestimated issue, this regulatory one. The second one, I was mentioning it to one of the participants, in many financial institutions, and I think some of them were around, there are not enough people in their ranks and at the different layers of the decision-making process who understand, those investments. So even if you convince, the frontline person, I'm sure, Asad, you've seen that very often, then it gets lost, in the weeds, because the next person who reviews these things say, we've never done that, I don't understand it, where are the benchmarks, etc., etc. Then then you lose it there. And so there is really a matter of human capital in the largest, most sophisticated, institution that needs to be addressed.
Great point. And I think carry on that thought. Ian talked about accountability. Cheryl talked about regulatory, statistics or institutional investment. I'll talk about RA. Best, maybe one of you guys help talk about CRA has played pushing invest all the banks, insurance are invested because of investment act. Is that something that worked? Any one of CRA folks, an expert, want to talk about that? We have two volunteers.
I'm not an expert. I would just say, does the CRA actually discourage investment because it creates a non-financial return that banks seek to, for lack of a better term, monetize through expense reduction? So they do it that way as opposed to actually investing in communities. So does it scare away does it scare away more sustainable capital?
I can discuss that. Marilyn, what do you think?
I would say that's an interesting point, but I'd say since 1977, when the CRA was enacted, basically it told financial institutions operating in the United States, if you're going to take deposits out of a community, you have to put them back in. You can't say, oh, geez, we have branches all over Harlem and the Bronx, but we just really only want to lend to people on Park Avenue, below 96th Street. So that was the impetus. And I think that it was one of those regulations that for a long time, people are, yeah. But it really, the rubber hit the road when this not performing under CRA prevented banks from merging. So this is where you have some stick with it. It's not just this is a nice thing to do, this is something you're going to be evaluated on. And I would say most of the major institutions in the United States really have doubled down and put a tremendous amount of effort into this. So they're evaluated on 3 tests. They're evaluated on lending. They're evaluated in investment. They're evaluated on the service test. You've got 3 different banking regulators, used to be 4. It's not a perfect process, but I think that it has really concentrated the places where there's a lot of money to get money into a lot of places where there's not. So that's on the CRA, and I would say that CRA has been a huge driver for the low-income housing tax credit. There are non-CRA investors who invest in that. It's been a large driver in investments into my firm, which I'll talk about this afternoon. But I think CRA has been tremendously positive for getting money.
Chris?
If I could just add briefly to that. First of all, I think CRA has been positive, and it's evolved over time and has had quite a lot of effect. But to the point about government regulations, you can push the government to pass regulation, but you can't push them past a good regulation. And I think the recent Tax Act Opportunity Zone legislation may not work as intended. And in fact, at the moment, it looks like it's going to have a lot of bad outcomes in many ways. So regulation is important at times, but it can have a negative outcome as well. Yeah.
I see a couple of hands. Thank you very much for participating. participating. Yeah, go ahead.
So just back to the CRA,
you
my
can
name is
introduce
Andrea
yourself.
Robertson and I work at TD in Canada. So I want you to know that in Canada we have CRA envy because and please don't quote me on that, because if if the CEO of our company heard me saying that, he'd probably freaks, because bankers in general don't want that. But in the sector, we really want that. And I see my colleagues in the US, because as you know, TD has a large presence in the US, making a lot of investments in affordable housing that, we're not doing because they're fueled by the CRA. So in the impact sector in Canada, we wish we had the CRA because we think that would fuel a lot of community development that, isn't happening as easily today. So just wanted to make that comment from a Canadian perspective.
Great. I think I saw some hands. Thank you very much for sharing that.
I also wanted to mention, and I'm not Dutch, and I don't know Dutch law, but I think of FMO, for example, and others in Holland, I think there's some tax incentives for people to make impact investments.
They were taken away.
And, they were
used
taken
to be.
away.
They used
Okay. Well, then, yeah, and I agree that the regulations like
It was the only country in the world that had
yeah,
that was taken.
and it didn't work. Okay.
No, it worked. It was change in government.
Yeah.
Matthias is there, the Dutch. Matthias, are you familiar with what we're talking about, the tax and investment in arts?
Yeah, for green investments.
Yes.
So there was a tax incentive indeed, but the same counts for electrical or electric cars, and so it used to be quite all over the place, but yeah, it is apparently a big success, and I think they help to build the market, but right now, I guess there are other priorities of the government.
There was sure. Just a young lady there.
Hi, my name is Rebecca, and I'm with Temasek here in our New York office. We're a Singapore-based investment firm. I just wanted to make 2 points. I think first on the question of scale and that chicken or the egg problem, I totally agree with that problem, and I think, therefore, that it's not necessarily the role of institutional investors to develop that ecosystem, but rather for those earlier stage opportunities, it might be the role of impact investors that come from more of a philanthropic background instead. I think the plant-based meat industry is a good example of somewhere where it was initially grant funded, and then as it developed and became investable for more commercial investors, that became, it became available for those investors. So that's one thought there. And the second thing I wanted to say, just to the general discussion on challenges that institutional investors face, is one about a mindset shift that I think needs to take place in order for investors to be even looking for these sorts of impact investment opportunities, and moreover to know what they're looking for. As we heard from Dana, it sounds like the Heron Foundation has done a really good job of looking at investments from all sorts of angles that typical commercial investors just wouldn't necessarily think about in the first place. So I think there is something to be said about retraining investors who come from commercial investment backgrounds to be looking for different things. And that's challenging. Would be interested to hear others' perspectives on how to retrain commercial investors to look for different things in investments.
I'm Bahar Gidwani from CSR Hub. One of the reasons I think that sustainability impact has been hard to measure is that it's highly fragmented because the interests of impact investors are fragmented. Different impact investors care about different things, and sometimes they're opposite things. One group might be interested in family planning, another might want not to have anything to do with contraception. Some care about the environment, some more about social. So when you're trying to measure impact investment, the problem is you have to do it from investor context. And since each investor has a somewhat different context, it's hard to unify those measurements and therefore agree upon which investments are in fact impactful and which ones are not.
So yeah, we were discussing, and Mary Rose, please join me in this discussion. How to, and I'm talking from basically from a DFI perspective. I used to work for FMO 8 years, and we discussed how to come to kind of how to trust each other and how to become more effective, especially also on the legal side where I'm a lawyer. And what I discussed with Michael is, we found out that it is really important to kind of come to certain market standards first of all, but also to trust each other in order to become more effective and efficient, but also for the borrower to be able to deliver what is actually important, like reporting, the actual impact. So what the initiative, what the DFIs, Proparco, DG, and FMO had in mind, and that goes back, I think, 8 years, is the friendship facility, which basically combines all the general principles of the 3 DFIs, and that worked actually after a lot of efforts, discussions, worked quite well, and I think it serves the borrower very well, because what you saw before is that each institution had their own requirements, their own reporting, their own KYC requirements, their own you name it, which was such a lot of effort to be and burden for especially for the client. That you can ask the question whether that's actually creating impact. Well, impact in terms of burden for the client, it is, but and that actually became and is going to be, and I think IFC was mentioned as well. These institutions, I guess, are more or less a front runner in if you will, impact measurements, impact requirements, which might become kind of a standard. And what I want to say and hope is that we can follow each other in terms of taking the lead and follow the leader and trust that institutions like we all here are more or less serving the same purpose and the same goal. And there might be little differences, but especially on a management level, we need to come to certain efficiency, and that means that you have to follow others and make sure that works, and that everyone on the floor is backed by management to go that route, to follow the others, and to trust that it will eventually be a great, important impact deal.
Collaboration, sharing of due diligence, regulation, with the Michael's comment that it can be, less efficient. Comment and two-edged sword is what the discussion are shaped up to be. Yes, please, Maria.
I'm Marie-Aimée Bourry from Société Générale. And I think another area of collaboration which would be very useful to solve some of the challenges that were raised is the sharing of information. So it's absolutely true that from a regulatory perspective, the capital allocation that were imposed on us with the different BAL and soon the BAL 4 regulation is not at all helping us to move beyond our traditional businesses. And despite the fact that we have very good track record in project finance, that we have evidence with our expert models that the payment default is very low, yet the new regulation is going to impose on us more capital for this. So if we want to move even further and say, let's do off-grid solar in Africa, it's a no-go in terms of risk return. So it's very difficult for a private bank to invest a lot of capital, even if we want to then recycle it through the capital market. For the instant it goes into our balance sheet, it does not make sense, so it's difficult to convince our management to do that. But one thing that could be very helpful is if all the institutions that have done that for the past 20 years, like Deutsche Bank or like the development banks, put this information into data commons, this track record that proves that microfinance has overall performed, all the statistical series that are available. Is there a way to put that in common? And likewise with the development banks, I know there is this database that all the DFIs and MDBs share, which is called GEMS, but they keep it for themselves. And if we had access to this track record, which by the way I think belongs to us because it's taxpayers' money, that have been, all the equity and maybe not the debt, but at least the equity from all the multilaterals and development banks is taxpayers' money, it's public money. So I think the sooner this is available in the public space, then we can calibrate our capital allocation model to say, well, maybe we don't have a track record in microfinance, but look, there is 20 years of statistics, and the default rate is lower than any, credit consumer loans or car consumer loans. So why hasn't it been done yet is a key question. And the sooner we do it, the sooner we can improve our models, and that will help with the scale-up. And the second point I wanted to make is on standardization, because to achieve scale, we need to do more quickly and in a more standardized way. And as a project finance banker, I know that what project finance people love is, being super customized and take care for every single, risk that we have assessed. And it takes forever to close transactions. And on top of it, we're adding another layer of impact measurement. So when we're done with monitoring every risk and making sure it's all addressed with the right covenants and negotiating for 6 or 12 months all the docs, we also need to look at how we measure impact, which is nobody knows, and it's going to take a lot of time. It's going to cost money. So maybe we should all impose on ourselves to just be more standardized, and maybe we take a bit more risk by doing so, but we could originate much more, much faster. And that's where maybe there should be some form of credit enhancement that should be available from the NDBs to cover for that kind of, basis risk that, okay, you've standardized a bit too much, but I'll be there for the first loss in case this, one in a lifetime event occurs and you've not properly worded your covenant to cover for this occurrence.
Good, thanks. Good point. Sorry, excuse me, Richard. Would you like to comment on Maria's comment about first loss risk taking or Cheryl from the development bank as to what are the limitations for OPIC to first
Sure.
loss?
Thanks. Yeah, I'm Richard Greenberg from OPIC. I don't want to comment on the best use of taxpayer dollars, but OPIC itself does not use any is a net contributor to the budget every year, just to flag that. And the future Development Finance Corporation, which is now been passed in legislation and just pending having a fiscal 20 budget to be formally launched. I completely agree with the comments and the notion of and the importance of having that information be available from not just development banks, but from all the practitioners who have been in the space to establish the track record. And we've been having some conversations with people who are looking to innovate in that area with just ideas around the need to meet the gap. And I'm thinking about the comment, I think, from Michael about the lack of financial intermediation in the space. So absolutely fundamental. Everything that's been said resonates in terms of the time, the cost, the additional efforts that are needed to make that decision. So we at the development banks like OPIC, obviously that's what we do for a living, and we've learned how to do it, but we don't necessarily have the efficiency built in, and most importantly, to attract the institutional capital in a way that's efficient. So it seems to me someone needs to develop, I know there's been a lot of discussions around different kinds of platforms to share the information. I don't know that they've been successful, but I think that field needs to continue to be explored so that there's sort of a wholesaler intermediary there that can gather information across different investors and then package that up, if you will, for institutional investors. I'd be interested to hear if any of the institutional investors here have worked on anything of that sort or have any reaction to that.
I think also, Richard, the new institution has, they've been talking about taking more risk, capital, and that's been one of the criteria. Clearly, there's a role for DFIs to take some of the perceptual risk out of the equation.
Value add creating for institutional investors. Have rides in that regard, products, and try to.
So, Mark, do you want to comment a little bit about how Alliance sees early risk, and there were some mitigants that stage, yours and the Carlyle group? You want to, or the young lady back from Temasek, you want to comment on what these elements of risk reduction that Maria from SocGen was talking about? Would that be something that facilitates institutional investors to come to impact investing? Say some of the earlier risks were taken by development banks?
I can speak maybe less directly to that exact point, but just quickly on some of the challenge. So Mark Finkel at Alliance Bernstein. So first I'll do my pitch, even though it's not really a pitch, that I'm generally proud, not just of Alliance Bernstein, but of some of the other larger asset managers as it's concerned that we're developing different strategies for ESG, sustainable and impact. And while we're not maybe able to have the direct impact in some ways that some of the smaller firms can have, there's a lot of capital to be allocated to space, so that's good. But I think one of the problems is also what I just said, that we have ESG, we have sustainable, we have impact, and we use all these different terms to describe things that are nuanced and slightly different but confusing as we talk about it in these different ways. And I think that the tension doesn't only exist on the confusion on the investor allocator side, but also on the asset manager side, where I talk to people that consider themselves sustainable investors and they don't like the term impact, and impact doesn't like sustainable, and sustainable doesn't consider ESG to be a part of the same field. And really, we're all on the same side trying to achieve the same goals of using private capital, because public capital isn't enough to meet the challenges that we need to achieve these objectives. And so I just think an important thing is standardizing in some respect, or at least coming to terms with the language that we can use in a way that can be productive rather than detrimental to what we're trying to achieve.
Thanks for sharing that. Anybody else? Young lady, do you want to share something? I'm sorry, I don't know your name. What's
Rebecca.
your name? Rebecca, could you want to share?
Yeah, I guess just to your question, short answer is yes. Temasek in particular is really seeking opportunities that are sustainable and have impact for investment. So I think if they come up and have been somewhat de-risked, then short answer is yes, we would certainly be interested.
Courtney again from Morgan Stanley. I was just going to say that I think there's also a role for some of the DFIs to seed impact funds, and I think be that anchor institutional investor in a way that they obviously bring a huge track record of ESG compliance, which I think is the backbone of what has become impact investing. So I think a lot of it comes down to structuring, whether that's, we have an impact fund of funds platform as well, where you can really get access to smaller managers who are doing really, they know their markets really well. They're achieving really authentic impact in ways that larger institutional investors with large ticket sizes can't necessarily do that efficiently. So I think there's a lot of innovation around structuring where I think if you folks can come to the table, and I know that's already happening in lots of corners of the market, but hopefully we'll just continue to see more of that.
Great. Yes, I'm over my time. Sandra is looking at me, and I think that we have lots of people wanting to. I'm going to say, let's cut in 5 minutes and let's take some comments. Go ahead.
John Larkin from Avenue Capital. Where's John Larkin from Avenue Capital? We have our first impact fund. I will tell you that when people tell us that you can become an ESG fund overnight, we need one of those things. I will tell you it doesn't happen that way. It takes us years to get to that point. But I'm going to be the cheerleader kind of here. Something changed 6 months ago for us, and that the institutions did come. large, big pension funds did come. So I know we all tend to. I made a comment one time. I was on a panel, and it seems like the same people were all in the same panel. We'd seen each other like 1,000 times before, and we looked in the crowd, and no offense, it was the same people in the audience, and something is changing right now. I don't know what it is. I'm the anecdotal guy. I don't know I don't have any facts behind it, but the institutions are coming. One of the complaints I used to always have with some of the banks, sorry guys, sorry, is that you tend to put the ESG person completely separate from the portfolio management side, right? So when you have a meeting with the ESG person, they tend to not, they could be even at odds with the person who's actually doing the origination and doing all the work. That needs to come together. Somehow the banks need to figure out how those two people work together. But the only thing I want to leave you with is blended finance, absolutely. It's working here in US and Canada with our deals. It is working its way. We're talking to some of you folks out there, some of these international deals. But this, something happened very positive on the institutional side and with the consultants 6 months ago, where folks like us in Avenue now are seeing pension fund money come to us. So don't give up hope. That's all I would say.
Great. Thank you. I'd like to ask you. You're not a consultant. Oh, sorry. I thought you were the key problem, but I'm just kidding. Okay. Great. I think we have a lot more interest. We'll take that. And Cheryl, last comment, and then we'll call it a day.
Yeah, I'm Edward Marshall. I'm at Developing World Markets. And I think one interesting development over the past 18 months is that there are investments in GPs that are taking place into smaller impact managers. And I think that can help facilitate some of the scale ultimately when you're looking at very niche sectors. So I think it's actually a positive signal for the future.
Comment on the DFI rule based on having worked for 3 of them. I think what a DFI can bring in is deep experience in the regions and those markets. That is indeed because we have been at it for many years, and that's the only thing we do. So that's the only thing we know. Also, as I like to say, if you need help to invest in Africa, and I help you. If you need help from me for Connecticut or Bavaria, maybe find somebody else. But however, DFIs will not de-risk your investment platform in a sense of it's not blended. DFI do not provide blended finance. They will be always pari passu. And when they are not, in fact, they're using some special account they get from somewhere else. Maybe FMO would get the Dutch government to open a certain line, etc. And in a way, maybe because I've worked for those institutions for too long, I'm more focused on the limits of what they can do, the institutional limits. If DFI were really the solution, we wouldn't be here. So we are here because the DFI are not doing or cannot do enough for all types of reasons, and another conference, would be required to address it. So I'm just saying that. So let's not keep focusing on the DFI because this will not be the answer. It can help. It can, get you there. One thing, for example, for my group doing renewable in a frontier market since 2008. Well, we had to do first-time teams not only by choice but by necessity, because otherwise I wouldn't have done a single investments because there were 0 teams. Same thing for microfinance when we're doing it, when we were in greenfielding. We had to take groups which had never done it before. There is an art based on experience on how you do it more often successfully than not. But again, I go back for some risk-return profiles, we need a new approach. Otherwise, we're really not moving the frontier from where it is now.
Great. Thank you. I'm just going to conclude with a couple of thoughts, and I think it may reflect what you said. And clearly, the issue of scale is there, and through collaboration, sharing the ideas of sharing due diligence could be achieved, and other approaches could be the regulatory, the CRA example, and keeping it efficient remains a challenge. Development banks do have their limitations, as Harold said, but as Steve Jobs said, all the rules we make are meant to be broken. So we can break the rules. I think it's a matter of some, the political pressures. IFC and others make billions of dollars in profits, and that those monies could be used for higher stage. So it's a matter of, sort of taking those risks. And I think it's being recognized because I've seen David Bohigian from OPIC, who's really a good thinker and was the acting president, talk about taking additional risk. I think our role and your role here is meaningful. This is what this discussion is, not in just futility. But we are seeking for you to engage in the working groups and to think more about it and provide recommendations. There's a lot of institutional investors today at the meeting, and rather large ones. Carlyle, Temasek, Alan Bernstein, also Morgan Stanley, Deutsche. There's lots of you, SocGen. So it's not that and I'll leave you with the words of Helen Keller, who's one of my I admire her, and she said that I am one, and I am one, and I am only one, but I can do something, and it is the something that I can do that I will not ignore. And I beg you to participate, continue the effort, and just like the banks that never wanted to be in microfinance, all are in microfinance. There will come a day, and I appreciate the comments from the gentleman, that this tide will turn, and this catch-22 challenge will come over time. Look forward to the afternoon with the discussion with Bob Nible and Deepak Kamra, who's a managing partner at Carlyle, the largest venture company, and with some of the practitioners like Sonu Kangrani, who are sort of the leaders in this field, to talk about the opportunities as well. So thank you, and enjoy the lunch, and we will come back, Sandra. It's been a great morning. I really appreciate your discussion. Thank you.